Is March Madness really a thing? Stay tuned. Welcome to this week's edition of NoteSchool TV, and we are glad to have you today. Let's do a little housekeeping before we jump into the March monthly update. Yes, and the teaser, well, there's madness, right, in the real estate and note market, for sure. And so we're going to talk about that and what we really mean by that as we go forward here. So before we do, let's just jump in and say, hey, make sure and like this episode. Yep, just hit the like button. Make sure and share this with your friends, your associates, everybody you know out there. This is very solid today about, well, really what the market looks like today, but what it looks like as we move really through the rest of the year. You know, next week is April 1st. So, you know, the train is moving down the track, so make sure and share. If you have any questions or comments you want to make on anything that we go over today, just make sure and type those in as well. And then also, if you have not already subscribed to NoteSchool TV, simply go in and subscribe. And then hit that bell notification. Yep, bing, go ahead and hit it so that you will be notified. When? Well, right before we go live every Wednesday at 11:05 Central Time. Again, every Wednesday at 11:05 Central Time. And then if you have any questions about what we do at NoteSchool, or you want to learn more about NoteSchool or come to a NoteSchool class, simply go to noteschool.com/TV. Again, noteschool.com/TV. With that, well, Eddie's not going to be with us today. He is at a mastermind in Tampa called Family Reunion. It's a lot of the marketers that are out there. So he and our Chief Market Officer, Max Keller, is there for the next couple of days. And so we're going to go through and do this and have a good time with it. So let's get started. All right, so it is March. It is the end of March. It's the last Wednesday in March. So let's just move right on and talk about the housing market. What is it? One of the Chinese philosophers said, may you live in interesting times. And these are interesting times, right? So we'll start out today with the builder unsold inventory. So jumps to 2009 levels. So when we look at that, we say, let me get my pen going here. When we look at that, what we know is that 2009 inventory levels were through the roof, right? We had the housing market crash. We then had the banking crash, and all of those things, and inventory had piled up. So builders like Lennar and D.R. Horton and Pulte and all of the big builders out there, well, they're piling up in inventory. And what this is forcing them to do is spend, a lot of money incentivizing buyers to buy by giving them upgrades, kitchen upgrades, loan buy downs as far as interest rate goes. And we're looking at the average of over $50,000 per house sold. So, yep, here was 2007 when it really started to hit, and that's this line here, and then the highest since 2009. Again, this was when, the market was on fire and rates were low and all of those things. So we then go to, from NAR, from the National Association of Realtors, we go to the existing home sales. Now, existing home sales advanced 4.2% in February, right, to a seasonally adjusted rate of 4.26 million. And that would be not for the month, but for the year, seasonally adjusted. But sales slipped 1.2% from a year ago. And then here's the other facts that we know. The median existing home price continue and has risen 3.8% from February 2024 to $398,400, the 20th consecutive month of year-over-year price increase. So there's a lot to unpack in these statistics and these things that we're looking at here, really, because you would think that, well, you know, the market would be on fire, the prices would go down, all of those different things would start adjust, but they haven't as of yet. And then the inventory of existing unsold homes rose 5.1% from the prior month. So there's a lot that's, when you say it's March Madness, it really is. It really is. We're going to get to rates in just a second. I'll give you a little diatribe there. But the median price, existing single family homes, existing, not new construction that's on the market, but existing, again, has jumped up a bit, and it's right around $400,000 as far as the existing dollars for homes that are for sale, existing homes. Again, we look at this. This is from Fast & Company. I love Lance Lambert there at the Resi Club. But you look at this. We've been showing this every month. Of course, Florida was leading the pack as far as change of unsold inventory or active inventory from February of 24 to February of 25. We've got Nevada over here. We've got California. We've got North Carolina. So, you know, there's a lot out there. 35% here, 38% here. So inventory is no doubt up. I think the only place it's down is in good old North Dakota, right? So we know there are a lot of houses for sale. We just know that they're not moving. And in Florida, one of our biggest deals is that condos are really staying on the market, dropping in prices, simply because of the new condo rule, as far as they must meet new standards for any condos that were built more than 30 years ago. So a lot going on there. And then here's the sentiment, right? How concerned homeowners are about affordability in their market. So if we look, of course, the dark blue here, so between the very concerned and the somewhat concerned, okay, here's 47 and 35. That's, what is that? Over 70% of the folks are concerned. And this, we look at this, and it's all in the high 40s. Look at the West, 59% and 29%. So we're looking at almost 90%. And this is what people are feeling, right? And then we look at it overall in the U.S., where 49 are very concerned and somewhat concerned. So not really, again, looking for something's going to give, right? I think we may have to go through a little bit of pain before we get to that stable market that we would have had years ago, where supply and demand were equal, and all of those things happened, but people are still very concerned about what's going on in the marketplace. The only thing that really is the most concerning part of that is not really interest rates. We'll get to that in just a second. Here is year-over-year gain. So here's what I pulled from this when I was looking at this yesterday. CoreLogic just reported that 1.1 million homeowners have negative equity as of the fourth quarter of 2024. We won't have the first quarter of 2025 until the first quarter of 2025 is over, right? But the red states here, the red states are the top 10 states with the highest average gain. 14,000 in California, 13,000 in Nevada, 11,000 Wisconsin, New York, Maine, Florida is negative. So there are the top 10 states. A lot of those are just right in this Northeast area. 1, 2, 3, all of those are there. So negative equity in a market like today, and I think we'll be able to see one of the biggest reasons why before we wrap up today, but I'll kind of give you a hint of that. And that is areas where, or the loans, the FHA and the VA loans, that's where your biggest challenge is. And typically those are going to be your very little money down loans. And you're allowed to have higher debt to income ratio in some of these, in what's going on there. And I'll show you the numbers as to what it looks like as far as delinquencies or non-performing in those areas. So 1.1 million again is the number for negative equity. And you go, how can that be so? Well, if you live in one of the markets where it's dropped a bit and you've got a 97% loan, it drops, a few $1,000s, and all of a sudden you're in negative equity territory. So, yeah, that's a thing. And then we know that it's affordability. And when we look at the U.S. market, so 63 mortgage applications have dropped 63% since the pandemic peak. And then the 2008 financial crisis compared to pre-pandemic limit remains down 52%. So these are just what we're looking at. The affordability crisis is deepening with the income required to purchase a median price home. What did we say a median priced home was? Well, it was $398,400. And so you need to make $115,000 to do that. And that's if you don't have, a family doesn't have 2 new cars and $500 to $800 a month monthly car payment. So it really squeezes the budget. $115,000 sounds like a lot, but when you live with that, it becomes a challenge, right? So this is what they say. We're witnessing the biggest collapse of home buyer demand in U.S. history. Interesting. Not calling for gloom and doom here, right? So just there's going to be some adjustments that are going to happen. Here's the national payment to income. So the debt to income ratio, the only time it was higher, right, was there in 2007, which is when the housing market crashed and then everything else. So we're sitting at about 33.5% debt to income. So this is on the PITI payment only, not credit card payments and car payments and boat payments. It's just on the debt to income ratio on your monthly PITI payment. So yes, absolutely, it is the truth that there's where it is. Let's talk about banks. Let's talk about lending and the Fed. So yeah, we've got 30-year fixed rate is down a little bit from what it was last month. We were about, when I was making a new slide here yesterday, it was about 6.8. So it's ticked down just a bit. We all know that Chairman Powell and the Fed did not have a reduction in the federal funds rate last week at the open market committee meeting. So they didn't have a rate cut, stayed the course, right? So yes, it's come down just a bit. You get a 5-1 arm for 5.95. But when you look at the cost to get that, the difference between this and this is really the cost of getting the loan, the points and so on. But so this is about what it is right now. And this looks to be where it's probably going to stay for the rest of the year. So the Fed to 8 months on next rate cuts as tariffs increase, as tariff risks, inflation flare up. So this is a Reuters poll. So 2/3 of the forecasters, 67 out of 101, expected one rate cut by the end of June. Maybe not. And here's the other. We said right here, here's where we were. That's kind of where we, somewhere right in between there. But they're saying that we're going to end, Fannie Mae says we're going to end 2025, or through the balance of 2025, we're going to be at 6.8%. Okay, or something thereof. Now, there are some exceptions. I was visiting with a friend of mine the other day, and they were buying, they're buying a $2.7, $2.8 million house in Seattle. And they're putting $1.2 million down, so more than half down. They both have great jobs. They're both airline pilots, and they're have great credit, and they got a 6.3% loan, right? But they're putting almost half down. They're the perfect borrowers, right? Debt to income ratio is perfect, all of those things. So, there are some exceptions there. And then possible to start 2026, sounds like a long time away, but that we may see the 6.2 to 6.5. Okay. So as we look at this and say, okay, what is it all of this really means? Remember, right? And this irritates me more than anything. I'll get on my soapbox for about 37 seconds here. But just remember, folks, we are living, as far as rates being between 6 and 7%, that is the normal rate. That is the normal rate. You've heard us say this, Eddie and I, over the past 3 years, that the 2021, 2022, 2 to 3% rates were just a fluke. Okay? They were. Average interest rate over the last 50 years has been around 7.75%. Okay, that's normal. So we're in a normal range. Will we ever get back down to 5%, 5.5%? We could. I would say sometime probably maybe in 2027, right? Early 2028. But this is where we are right now. And really, I was doing a lot of reading last night. Yeah, I kind of nerd out on some of this stuff, right? So Powell, meaning Chairman Powell of the Fed, forced to start printing more money after the Fed lost $77 billion in 2024. A big number in 2023, 24. So bottom line is the Fed has lost $192 billion in the last 2 years. Okay. So losses came from paying banks more interest on reserves than it earns from its bond portfolio. So here's what this really means, right? This means that the Fed is charging 2.6% is the average yield that they're paying, is what they're receiving, but they're paying the banks on the reserves 4.4% on this 3.2 trillion in reserves. The math doesn't work, right? So the Fed is earning 2.6%, but it's paying 4.4%. This is all a direct reflection of lowering the rates in 2021 and 2022. And it's really everything that we've looked at and everything that we've the discovery we've made is probably 7 years to get that back to some type of normalcy where the Fed can operate effectively and efficiently. So $216 billion in deferred assets to cover losses without asking Congress for any money. Now, Chairman Powell did say, and I'm not criticizing Chairman Powell, but Chairman Powell did say that we'll pay this money back. But when you've got a differentiation between 2.6 and 4.4, that's pretty huge, right? So, yep, that's the banking or the Fed. And then we know that the mortgage credit availability index has really stayed the same for December, January, and February, and it's standing at 95.9, meaning that, here's when this whole thing started over in here, and we went from here down to here, and now we're down to here. It just simply means that this is a note cycle, pure and simple. It's a note cycle, pure and simple, because these people that are lost in this chasm over here, that's about 40% of the people that really can afford to buy a house cannot qualify conventionally. We call them, again, the penalty box buyers. That's what it looks like. They can't go out and they can't get that loan because, again, they're I-10 borrowers, they're contractors, they're gig workers, they're entrepreneurs. So that's what that looks like as well. So there we are. So again, there's always different cycles. And again, we know that when we look at this cycle, this part that we're in here now, we know that we're in a note cycle. We know it, and we're happy to be there. Also, when we look at that, we're more in it's a rental cycle versus a note cycle. And if you watched 2 weeks ago, Eddie and I did a lesson on the difference between, well, using your property, your rent house as a rent house, or using it as a note cycle. And we know that you can make 3 times more money than by selling the house with seller financing than you can by using it as a rental. We know that. We've proven that. Go back and watch that episode from 2 weeks ago. And here's really, Eddie said this a couple of weeks ago. He and I were doing a podcast, and he said that when you're dealing with rentals, right, you have total control and you have all of the work, total control and all of the work. If you're in a syndication, you have no control, right? And you have none of the work. When you're the bank, when you're seller financing and becoming the bank, you have all of the control and none of the work. So all of the control, all of the work, none of the control, none of the work, to all of the control and none of the work. And that's what we have to, that's what we know. And that's what we're, Eddie's talking about at the event he's at right now. So let's talk a little bit about commercial, multifamily, single family investors. Multifamily loan crisis looms as community bank delinquency soared to 6.1 billion. A lot, most of, probably 70%, as you've heard us talk about in the past, is that most of the multifamily loans are held by smaller community banks, right? Just because that was the business that they decided to get in. But community banks that are holding multifamily loans shown a dramatic rise in delinquent loans. And we know that, and realize not just unrealized losses, but realized losses. Yes, including a 12-year delinquency high of $6.1 billion. The record delinquency loans translates only to little less than 1%, but it is still almost $630 billion. So, yep, we're still in that cycle. We're still in the cycle of continually new apartments that had to be finished no matter what the market looked like coming online. And it affects the whole possibility. It will eventually work out, right? But right now, it's got to work itself out. Again, we go back to that whole March Madness thing, right? And, the other piece is that right now in the spring season, as we're getting there pretty quick, home sales are supposed to just go crazy, right? Shoot through the roof. This is the best selling time of the year. People are anticipating moving, school being out for the summer, and then moving over the summer but that's not happened so far. We'll see what happens over the next few months. Fannie Mae finds mortgage fraud in multifamily lending transactions. And here was the thing, and I think I may have reported this a couple of months ago, but here's the gist of the whole thing, is that Fannie in 2024 made a profit of $938 million on its single family loan portfolio. Okay, almost $1 billion. Fannie also reported that it lost $752 million in their multifamily portfolio. So this profit over here almost wiped out by this loss on this side. Fannie also discovered instances of multifamily lending transactions in which one or more of the parties involved engaged in mortgage fraud. Yeah, and continue to investigate additional multi-family lending transactions. So, yeah, that does, when you've got a lot of turmoil going on in a market, you kind of discover some of these things, and more to come on that. Rents continue to drop. March marks the 18th consecutive month of year-over-year drops in rent. Smaller size units, the studios and one-bedroom units, seeing the biggest declines, according to Realtor.com. And then all unit sizes saw drops, with the biggest drops in studio apartments and 3-bedroom, not 1-bedroom, but studios and 3-bedroom units. So the 1 and 2-bedroom units were kind of the stalwart of that piece. And even though a lower rate of completions in 2025, this is what we were talking about just a second ago, rental housing starts or stock is slated to grow by 1.1% to over 49 million units by the fall. Okay, so put that into perspective. At any given time in the U.S., there is about 53 million single-family homes out there, single-family homes, owner-occupied, that have a mortgage on them, that has a loan against those properties. So it's a huge number, and again, we'll see how that works out and when that works out. But we're in that cycle now of saying, okay, we're going to be here. Maybe we'll see a bit of a dip in prices and so on, but it'll eventually catch back up. And this has happened many different times in history, right? History always repeats itself. And then finally, for single-family investors in rentals, single-family rent growth drops to a 4-year low. Detached rentals, standalone properties, rents declined by 2%, marks 2 straight months of declining price growth. And then it's just a seasonal rent. So really, if you look at the 3 states that are most affected by that, is Texas, California, and Florida. South Florida, Miami, Fort Lauderdale, Tampa, and in Orlando and Jacksonville are really getting hit hard. In Florida, in Texas, you've got Austin, where it was that, and Boise, Idaho were 2 of the fastest growing markets in the U.S. back a couple of years ago. And so really, we go back to the old adage that what goes up like crazy sometimes has to drop a bit to get back down into reality. So single family, again, this is why when we look at what we can make out of the rent, what we can net, right? For house rents for $2,000 a month, our net's going to be about $1,000 a month. You sell that house, that $300,000 for $300,000, you get a $50,000 down payment. You're going to make a whole lot more money every month by being the bank versus being the landlord, and you have none of the complications that you have with being a landlord, right? Again, remember, rentals, all the work, all the control, the syndications, no work but no control. But then as being the bank, you don't have any of the work and you don't have to worry about the control because you've got all the control with the note. So single family, Fannie Mae fines, that we just talked about that. So we're going to wrap up today with non-performing loans. Here's what I was talking about just a minute ago. Fannie and Freddie single family and multifamily serious delinquencies, okay, increased in February. So Fannie reported that was up to, was 0.53 in single family serious delinquency. 0.56 up from 0.55 in January on single family. This is Fannie, this is Freddie. And then we look at Fannie in their multifamily portfolio. Serious delinquency rates increased, reaching the highest level since 2011 in multifamily serious delinquency. And Freddie Mac also experienced an increase in multifamily delinquency in February. Okay. So here's what all of that really equates to. There is a lot of information on this page, but I want to I broke it down so that you could pretty much see. And the highest delinquency rates right now is in FHA and VA. Again, these were 2%, 1%, 2%, 3% down payments. So if we look at 5.2% of FHA, borrowers are behind on payments. I dug deep here. There's 7,851,909 FHA loans on the books right now. If 5.2% of those are seriously delinquent, that means there's 408,299. VA, there's 3.7 million, 3.9% of this. There's another 144,000 delinquencies. 2.1% of conventional borrowers are delinquent. Now, remember, there's 53 million of those of the conventional loans on the books. So if we look at the numbers, and I broke this down. So, and the reason I did that is because the Wall Street Journal had an article came out a couple of weeks ago. It was pretty enlightening. And when we look at this, we go back over here and we've got, let's call it 409, 408 and 144. So 408,000, 144 plus 2% of 53 million. What would that be? A lot, right? Well over 1 million. So here are the delinquencies that are stretched out there, right? That are here. These are not the serious delinquencies. These are the ones that are usually typically less than 120 days past due. These are the seriously delinquent loans that Wall Street Journal reported was they're in the netherworld, right? These are the ones that are just sitting out there and they have nothing has happened to them. I'm not calling this political. I'm not saying any of that, but those loans, 988,555,000 loans, 1 million loans are just continuing to age. And this number is continuing to go up and nothing is being done with those loans. So these are the ones that really need to be flushed out of the system. You're always going to have some delinquencies, right? We're talking serious delinquencies, 520 due days on or 90 plus, and then you've got 1,297 days. And I may have shown you this last month, but I wanted to drive the point home, right? So in 2024, there were 321,000 foreclosure starts. 321,000. You've got, let's call it 1 million, right, that are serious delinquent, that need to be foreclosed, that are 1,300 days delinquent. Pretty serious, right? 10 times what the normal delinquency of 120 days would be. So 321,000 starts and only 69,000 completions. And so, and you've got 998,000 loans that need to be foreclosed upon. So what's going to happen with those? Eventually, they're going to have to be flushed out. It's just one of those things. And that brings me back to the beginning of this, right? The teaser, where I said that it's March Madness, right? It's March Madness. The sooner that we understand, the sooner that you let your friends and your associates and people that are saying, oh my God, you know, the interest rates are high, they're high, they're not. Looks like this is where they're going to be for the next rest of this year, is somewhere between 6.6 and 6.8, right? Prices, well, as inventory grows, prices will have, we're not talking about a 10% reduction in prices, but the market will, you know, it'll settle in a bit, right? But again, the Fed says, the Fed and the St. Louis Fed particularly, that does most of the research, says that it'll take 7 years. It'll be 2020 from like when the Fed decided to go, there was nothing accomplished by lowering the interest rates to such low rates in 21 and 22, right? Other than to put us into a thing here where the lower rates gave the house prices the chance to accelerate. So that's what it is. As far as rates, that's what we're going to be. Commercial, yep, there's still some problem. All of commercial, but we're focused more on multifamily here and single family, and that's why we say that it's a note cycle. It's a note cycle as we move forward, and then eventually there's going to be some great opportunities in this non-performing market out there. We're just not there yet, but it'll come. It'll come. So that's this week's monthly update. Yes, we won the best results for best of notes done by noteinvestor.com, as Colonial being our sister company, Colonial being the best distressed debt buyer in the business. Best podcast, NoteSchool TV, right? And then our yearly event, which is Note Expo, which just put it on your calendar. It is starts the second week of November. So that's it, guys. We appreciate you very much. Thank you so much for watching with us. We will be back on next Wednesday, same time, same place, and when 11:05 Central Time on Wednesdays. That's it. Take care. We'll talk to you later.